Welcome to the December market update and our final update for 2016. We're joined of course by Bill Keenan, General Manager of Direct Equities Research. And Bill, you talked about the US election obviously last month, but we've seen Trump had a sustained impact on markets. So what have been some of the key moves we've seen since November?
Yes, I mean there's been a steepening in the yield curve has been the obvious outcomes thus post the US election. There's a rising US dollar. And generally a move out of defensive stocks, so areas like infrastructure, REITs, telcos and healthcare, and movement into higher risk or higher beta sectors like banks and resources. So they've been the main changes in the market since the election. And
we've seen some strong rallies as well from oil and metals, but gold pulling back just a bit. So what's been behind this commodities rally?
Yeah, commodities have rallied pretty hard, and it's been a combination of factors actually, not just the US, but in China there's also been some supply issues. But chucking the US infrastructure growth policies as expected, steel and copper obviously being two of the beneficiaries. So we've seen iron ore and coal and copper rally in the markets. But oil's been rallying also for different reasons, mainly to do with OPEC efforts with Russia to reduce oil production, minor to date, but enough to get the oil price rallying. And also we've seen that gold actually has moved in a different direction. So it's been falling, and that seems to be on that the US dollar has been actually rallying, and this risk-on move in the market has meant that gold has actually suffered because of that.
And turning to Australia, we've seen the GDP figure print negative for the September quarter. So are we seeing underlying sort of deterioration in the economy, or will we see some sort of bounce back?
Yeah, it was a bit of a rogue figure. I think the market, or many economists actually expected it. It was just where a number of negative factors actually lined up together in the one quarter and led to a big negative print of negative 0.5, which is actually a pretty negative number. But you actually need two negative quarters to be a recession. Now, we don't expect the next quarter to be a negative print, and that is because some of the factors like exports and public spending in particular should bounce back next quarter. We mentioned that iron ore and coal have been a bit stronger price-wise too. So exports should bounce back quite strongly, and the other one is housing construction actually had a bit of a dip in the last quarter, which is thought to be weather-related.
So we could duck another technical recession? Yes,
we should. It would be a big surprise if it was a recession. So.
And now, unfortunately, we are filming this just before the Fed meets for its final interest rate decision of the year. Any comment on what's likely to happen?
Well, it's widely expected that the US Fed will now increase the rate, cash rate again in December to around 0.75. Now, that's happened because the new administration is thought to have a growth policies, so lower tax rates, higher infrastructure. So it seems the Fed, with the economy, US economy already travelling pretty well, it looks like the Fed is actually now behind the curve with this change in government policy. So they actually have to increase rates a bit faster than expected. So expect a rate hike in December, and the market's pricing in at least 2 rate hikes for next year.
And finally, how do these events change your thinking around Lonsec's model portfolios?
Well, the changes in the market have happened pretty rapidly since the election, and it's only been 4 weeks since that's occurred, and there's been some massive moves in the market. So at this stage, we didn't want to overreact, just have a think about our positions. We're comfortable holding the banks and resource weightings as we have them at the moment. We previously were thinking of moving further underweight, so we're now looking at holding those positions. I guess the focus is on the interest rate or the defensive sectors. We're looking at our defensive sectors and looking to replace them with quality growth stocks at a reasonable price. That's easier said than done. We are taking our time at the moment because we think the market's moved so fast that there actually could be some better opportunities to just take your time to get these changes right. But generally we're looking to lighten off defensive exposures, get a bit more growth, a bit more beta into the portfolio. So that's our mindset at the moment, and there will be some changes coming up over the next 1, 2, 3 months.
Well, Bill, it sounds like there's a lot of changes to adapt to there. Thank you very much for your time.
Thanks.
And to our viewers, you can catch the next market update in 2017. As always, for better investment outcomes, visit lonsec.com.au.